Well, the signs of a slowdown ramp up ever so slightly. Fixed income ETF inflows hit a near 8-month high for the week ending November 1, climbing 64% from the previous week. And muni bond flows were particularly strong, posting their first positive week in 8 and seeing their best inflows of the year. Investors have pushed a total of $1.2 billion into those funds so far this year, and our next guest still sees some buying opportunities out there. Joining us is Duane McAllister, Senior Portfolio Manager at the Baird Funds. Duane, welcome. Good to have you with us. It's surprising to me. I mean, is what's happening here a recognition that people think rates are beginning to peak and that this is a good time to lock in maybe or to go after those higher yields?
Yeah, I think that's exactly what's happening. Honestly, I think people are finally coming around to realize there's just really good value in the bond market, broadly speaking, and certainly in the municipal bond market. You know, high-quality taxable securities, you can earn roughly 6% today. You know, obviously up significantly from where we were just 2 or 3 years ago. But when you look at the municipal market, the tax-adjusted yields there are in the range today of 7.5% to 8.5%, depending on your tax bracket. And I think the compelling value is just really beginning to come through. People recognize that, you know, you buy bonds primarily for income and safety. But if you can earn somewhere in the range of 7 to 8%, now you're putting yourself in a competitive game, if you will, against other asset classes, including equity. And I think the other point is just that while you can get something like equity-like returns today in the muni bond market without taking a lot of risk, the volatility is probably a quarter of what it is typically in your S&P 500.
If you're lucky enough to live in a state like New Jersey, I think the tax equivalent yield might be even higher.
It is. We've seen, 9, 10% if you're in New York, New Jersey, California. And these are just really, really compelling values. And I think the other thing is that unlike the Treasury market, which obviously a big concern the last several weeks has been the abundance of issuance and supply, the muni market has been stagnant for about 15 years. Yeah. We've got about $4 trillion of outstanding municipal debt. That was exactly where we were, after the financial crisis of 2008. I would say that people perhaps underappreciate the checks and balances at the state and local government. If your local school district wants to borrow to build a new school, they typically have to come to market or come to the voters and get their approval. You can imagine how challenging that would be at the federal level, particularly when we deal with the debt ceiling just periodically. But most states have limits on the amount of debt that can be issued. So, we'd love to see more supply. I think we'll get more over the next few years, and hopefully, with the infrastructure.
Most states have to run a balanced budget. And as you just pointed out, my township just went through last year a big school bond issuance. It was hard fought. It was $180 million to do capital improvements that had been postponed. But at any rate, it ultimately did carry, and our taxes went up reflectively. But let's talk about, there are different pieces of the muni market. Where should, if I'm looking at individual, should I look at revenue bonds, GOs, what?
Well, I would start, first of all, with our view is that you don't have to step down in credit quality right now. In fact, we're focusing more on the higher rated issues, the AA, even AAA. One interesting little statistic is you can get 80% of the yield you would receive in a BBB bond in a AAA bond today. So you're getting well paid to stay up in quality. And a little acronym we've come up with is the bonds we like today are what we would call ROBs, or just regular old bonds. What people know when they think of the muni market, the GO bonds, school district bonds, water, sewer, essential service revenues. There's just really strong credits out there. And I think the final point I would make on that is just, these are domestic-based revenues. This is a U.S.-centric market, obviously. And it's a way to kind of escape all the uncertainty and global turmoil that we're seeing around the world.